On January 1st, 2026, at precisely midnight Beijing time, the Chinese Ministry of Commerce activated Export License Requirement number 2025-47B. What appeared to be routine administrative paperwork contained a single regulatory framework that would fundamentally restructure the global silver market within 72 hours. This wasn't a gradual policy adjustment announced with diplomatic courtesy and international consultation. This was economic warfare deployed during New Year's celebrations while Western markets slept and trading desks sat empty. The directive elevated silver from ordinary commodity status to strategic resource classification, positioning it alongside rare earth elements under China's export control law framework. Only 44 companies received government authorization to export silver during the 2026-2027 period. These aren't small boutique refineries or regional traders. These are the gatekeepers controlling approximately 121 million ounces of annual silver exports, representing between 60 and 70% of all refined silver traded globally. Let me put that number in perspective. When you control 70% of a market's tradable supply, you don't participate in price discovery. You dictate it. And China just locked the vault while Western financial institutions hold short positions worth billions of dollars, counting on Chinese supply chains that no longer exist in their previous form. The strategic implications became immediately apparent. Within the first week of January 2026, 3 major Swiss refineries suspended operations because they couldn't source the raw materials they'd relied on for decades. These aren't marginal players struggling with temporary disruptions. These are centuries-old institutions with client relationships spanning generations, and they literally cannot fulfill existing contracts. The $17 billion figure in the title isn't hyperbole or clickbait mathematics. That represents the aggregate value of existing forward contracts, futures positions, and physical delivery commitments that suddenly face force majeure conditions. Contracts signed in good faith throughout 2025, when Chinese exports flowed relatively freely, now encounter regulatory barriers that didn't exist when those agreements were negotiated. China exported over 4,000 tons of silver during the first 11 months of 2025, while importing only 220 tons. They operated as a massive net exporter, refining ore from global sources and sending finished product to manufacturers and financial markets worldwide. That dynamic just reversed overnight. Beijing now restricts outbound flows, while their domestic buyers panic purchase physical metal at any available price. The licensing framework establishes multiple verification layers that extend approval timelines from days to potentially months. Exporters must obtain both government authorization as designated state trading enterprises and standard export permits for individual shipments. This dual license system creates bureaucratic choke points where Beijing maintains complete discretion over which applications receive approval and which languish in administrative purgatory. Even more revealing are the qualification requirements. Approved exporters must produce at least 80 tons of silver annually and maintain $30 million in credit lines. These thresholds effectively exclude small and mid-sized firms from international markets, concentrating export activity among a handful of state-connected enterprises subject to political oversight and strategic guidance. This mirrors exactly what China did with rare earth elements between 2010 and 2015. They dominated global supply chains, then progressively tightened export restrictions until Western manufacturers faced acute shortages and had no alternative suppliers. The playbook is identical, the timeline is compressed, and this time the target commodity sits at the heart of 3 massive industrial revolutions happening simultaneously. Silver isn't optional in modern manufacturing. It's the most electrically conductive element on the periodic table. Every solar panel requires it. Every electric vehicle contains it. Every high-efficiency smartphone, laptop, and data center server depends on it. There is no substitute that matches silver's performance characteristics at any price point that makes economic sense at scale. The solar industry alone consumed an estimated 60% of total global silver production throughout 2025. That demand isn't discretionary or price-sensitive in the traditional economic sense. When you're building a solar installation with a 25-year lifespan and government subsidies covering installation costs, you don't comparison shop for inferior materials because silver prices increase 20%. You pay the market price and pass costs downstream. The same principle applies to defense contractors producing missile guidance systems, semiconductor manufacturers etching circuits for AI accelerators, and medical device companies developing antibacterial coatings. These applications require silver's unique properties. Substitution isn't feasible without fundamental redesigns that would take years and cost billions in development. China understands this dependency perfectly. They're not restricting silver exports because of environmental concerns or resource conservation. They're leveraging strategic control over critical supply chains to advance geopolitical objectives and economic influence. The official explanation about protecting resources and environment is diplomatic language masking resource nationalism and great power competition. The timing tells you everything you need to know about strategic intent. These restrictions took effect simultaneously with ongoing U.S.-China trade tensions, Western efforts to decouple supply chains, and Beijing's broader campaign to secure dominant positions in technologies defining the 21st century economy. The United States added silver to its nationally designated list of critical minerals in November 2025, acknowledging its essential role in electrical systems, renewable energy infrastructure, and defense applications. That classification recognizes strategic vulnerability. China's export restrictions exploit that vulnerability with surgical precision. Consider the cascade effects rippling through industrial supply chains. A manufacturer in Germany building solar panels operates on thin margins and just-in-time inventory management. They maintain perhaps 30 to 45 days of silver stock under normal conditions. Chinese export restrictions immediately transform that comfortable buffer into an emergency shortage, requiring dramatic action. That manufacturer has three options, all bad. They can halt production lines until securing alternative supply, destroying profitability, and breaching customer contracts. They can pay massive premiums to source physical silver from spot markets, eliminating profit margins. Or they can substitute inferior materials, degrading product performance and risking warranty claims. None of these options are sustainable. And multiply this scenario across thousands of manufacturers globally, all competing for the same shrinking pool of available metal, and you understand why physical silver prices in Asian markets are trading at premiums of $8 to $20 per ounce above Western futures prices. That spread shouldn't exist in an efficiently functioning global market. Arbitrage should close pricing gaps almost immediately. Buy silver on COMEX in New York at $71 per ounce, ship it to Shanghai where it's trading at $85, and collect the difference minus maybe $2 in transportation costs. Rinse and repeat until the spread disappears. But that arbitrage isn't closing, it's widening. Because when traders try to pull physical metal out of COMEX vaults to ship east, they're discovering something uncomfortable. There isn't enough available metal to move. The vaults report inventories on paper, but those ounces are encumbered by existing claims tied up in ETF holdings, or simply don't physically exist in the quantities the open interest suggests. COMEX operates on a fractional reserve system by design. The number of paper contracts outstanding represents roughly 300 times more silver than physically exists in exchange vaults. Under normal conditions, this functions smoothly because most traders close positions before delivery. But these aren't normal conditions. Industrial users now demand physical delivery because they can't source metal through traditional supply chains. The registered silver inventories available for immediate delivery at COMEX have plummeted approximately 70% since 2020. London Bullion Market Association vaults lost around 40% of their holdings during the same period. Shanghai inventories fell to decade lows. At current consumption rates, some industrial regions maintain barely 30 to 45 days of accessible reserves. This inventory drawdown occurred gradually during 5 consecutive years of structural supply deficits. Global demand consistently exceeded mine production plus recycling by 150 to 250 million ounces annually. The market absorbed those deficits by liquidating above-ground stocks accumulated during previous decades when surplus production created inventory buffers. Those buffers are exhausted. The strategic reserves that smooth supply disruptions and stabilize prices during temporary shortages no longer exist in meaningful quantities. And China just cut off the supply line that was supposed to bridge the gap between insufficient mine production and relentless industrial demand. Mine production can't ramp up quickly in response to higher prices. Silver mining is predominantly a byproduct of copper, lead, and zinc extraction. Primary silver mines represent only about 30% of global production. That means silver supply responds more to base metal economics than to silver prices themselves. Even primary silver miners face multi-year development timelines for new projects. You can't decide to open a silver mine on Monday and ship metal on Friday. Exploration, permitting, construction, and ramp-up to commercial production typically requires 5 to 7 years minimum. By the time new supply responds to today's price signals, the market will have endured years of acute shortages. The economic implications extend far beyond commodity traders and mining companies. Every consumer who purchases electronics, drives an electric vehicle, or benefits from solar energy will feel these disruptions through higher prices and reduced product availability. Every nation pursuing renewable energy transitions will face strategic vulnerabilities as critical materials become geopolitical bargaining chips. The financial system faces its own reckoning. Major banks and trading houses maintain massive short positions in silver futures, betting that prices would moderate as mine production increased or demand softened. Those bets assumed supply chains would function normally and Chinese exports would continue flowing. That assumption just proved catastrophically wrong. When your short 275 million ounces of silver and physical supply suddenly tightens, while industrial demand remains inelastic, you're facing a classic squeeze. The Hunt brothers in 1980, the 2011 spike. Every silver squeeze in history ended the same way. Commercial shorts scramble to cover positions, prices spike until someone changes the rules, and volatility reaches levels that dwarf normal commodity cycles. The difference this time is that underlying fundamentals support sustained higher prices rather than speculative bubbles. This isn't a corner created by wealthy individuals trying to manipulate markets. This is structural supply deficit meeting, geopolitical resource control meeting irreplaceable industrial demand, the perfect storm. China's licensing framework enables graduated escalation without formal policy announcements. Initial quota reductions during 2026-2027 could progressively tighten until achieving de facto export prohibitions. This approach mirrors rare earth policy evolution, where gradual restrictions avoided sudden market shocks while achieving strategic objectives. Beijing maintains complete flexibility to adjust export volumes based on diplomatic negotiations, trade relationships, and domestic priorities. If U.S.-China tensions escalate, expect tighter restrictions. If negotiations produce concessions Beijing desires, perhaps export licenses flow more freely. The metal becomes a bargaining chip in great power competition. Western nations face uncomfortable choices. They can attempt to develop alternative supply chains, but that requires years and billions in capital investment with no guarantee of success. They can maintain strategic stockpiles, but that requires purchasing metal at elevated prices and storing it unproductively. Or they can accept dependency on Chinese supply at the price of political influence and economic leverage. None of these options are attractive. All involve significant costs and strategic trade-offs, and delay makes every option more expensive and difficult. The countries that act decisively now to secure supply chains and develop domestic capacity will fare better than those that hope market forces or diplomatic negotiations resolve the crisis. For investors and market participants, the implications are equally profound. Paper silver contracts on COMEX and LBMA increasingly diverge from physical reality. The futures markets that have dominated price discovery for decades may lose that function as physical scarcity drives premiums in regional markets. We're witnessing the beginning of market bifurcation, a paper market where contracts trade at prices determined by leveraged speculation and exchange rules, and a physical market where actual metal changes hands at substantial premiums reflecting true supply-demand fundamentals. Eventually, physical reality prevails. Paper prices reprice to physical markets, not the other way around. Investment demand is rising alongside prices, exhibiting monetary characteristics rather than typical commodity demand curves. SLV, the largest silver ETF, saw increasing inflows as prices rallied throughout late 2025. Investors are buying more as prices rise, treating silver as a store of value and inflation hedge rather than an industrial commodity. This dual nature as both industrial metal and monetary asset amplifies potential price movements. Industrial users must purchase regardless of price to maintain production. Investment buyers increase allocations as prices rise, viewing higher levels as confirmation of thesis rather than reason to sell. These reinforcing dynamics create feedback loops that can drive prices far beyond what traditional commodity analysis would suggest. Speculative positioning data from CFTC shows that managed money remains relatively light in silver compared to historical extremes. Despite the massive price run in 2025, net long positions represent only about 19% of open interest compared to 31% for gold. There's substantial room for additional speculative capital to flow into silver before positioning becomes crowded. The comparison to gold is particularly relevant given Bank of America's recent forecast that silver could reach between $135 and $309 per ounce, based on historical gold-to-silver ratios. At current prices around $75, the gold-to-silver ratio sits near 59 to 1. The 2011 low was 32 to 1. The 1980 low was 14 to 1. Mean reversion toward historical norms implies dramatically higher silver prices even if gold simply maintains current levels. China's export restrictions accelerate the timeline for these dynamics to play out. What might have taken years to develop is now compressed into months. The structural deficit that was gradually drawing down inventories just became an acute shortage, requiring immediate response. Industrial users who operated on just-in-time inventory management are panic buying to secure supplies. Financial shorts who expected normalcy are scrambling to limit losses. The geopolitical dimension adds urgency and unpredictability. If China decides to tighten restrictions further in response to U.S. policies or trade actions, another leg down in available supply could trigger panic. If Beijing decides to flood markets temporarily to destabilize Western manufacturers who invested in alternative supply chains, price volatility could whipsaw in both directions. This uncertainty premium alone justifies higher valuations. Markets hate uncertainty. When critical industrial inputs face unpredictable availability at the discretion of a geopolitical rival, buyers pay premiums for security of supply. That premium gets priced into physical metal and eventually forces paper markets to acknowledge reality. The transformation from ordinary commodity to strategic resource represents a fundamental shift in how silver trades and gets valued. For decades, silver was primarily an industrial material, with some monetary characteristics and investment demand. That hierarchy is reversing. Strategic resource status and critical mineral classification mean governments and large institutions must secure supplies for national security and economic stability. When commodities achieve strategic status, normal market mechanisms break down. Prices stop responding to marginal changes in supply and demand. Instead, they respond to worst-case scenarios and security of supply considerations. Buyers don't optimize for the lowest cost. They optimize for guaranteed availability, regardless of price. This is the $17 billion shock that's now rippling through global markets. Not just the immediate contract values in distress, but the recognition that fundamental assumptions underlying industrial supply chains and financial positions were wrong. The comfortable certainty that Chinese silver would always be available at reasonable prices just evaporated, and every business and financial institution exposed to that assumption must now adapt to a new reality they didn't see coming. The speed of the change is what makes this so devastating. Gradual transitions allow time for adjustment and adaptation. Sudden shocks create chaos and force errors. Companies make desperate decisions under pressure. Financial institutions take losses they could have avoided with better information. Markets overshoot in both directions as fear and greed overwhelm rational analysis. We're in the early innings of a transformation that will define commodity markets and geopolitical relationships for years to come. China fired the opening shot. Western nations and market participants are still processing the implications, but the $17 billion shock isn't the end of the story. It's the beginning of a new chapter in great power competition, resource nationalism, and the strategic weaponization of critical supply chains. The question now isn't whether silver prices will rise. That's virtually certain given supply-demand fundamentals and geopolitical dynamics. The question is how high prices must go to ration scarce supply among competing industrial users, how long shortages persist before new supply emerges, and what secondary effects ripple through financial markets and the broader economy. For anyone paying attention, the message is clear. This is over. The era of abundant, cheap silver flowing freely through global supply chains ended on January 1, 2026. What comes next will be more expensive, more volatile, and far more strategic than anything we've experienced in modern commodity markets. The shock is here. The adaptation is just beginning.